name is Aaron Arnold, and I'm here today to talk to you on our latest quick hit educational video about 5 reasons to consider investing in a balanced portfolio versus a GIC. We have been getting a lot of questions recently around these elevated and tempting GIC rates. It's not uncommon today to see a rate of 5 to 6% offered by a bank or Tangerine or another institution out there on that money. And the decision on whether to take advantage of this or not should really come down to 2 things. First of all, the first thing to consider is, when do you need the money and what is the money for? If this money is for the short term and you plan on using it within the next year or two, we believe that these GICs or high interest savings accounts are a great tool because they will provide exactly what you expect at the end of that term. You know what you're going to get, and you can avoid all the market volatility. However, if this money is longer in nature, say 3, 4, 5, 10 years, potentially it's for retirement and to pay you an income over the next 20 or 30 years, here are 5 reasons to consider investing in a balanced portfolio versus a GIC. The 5 things we're going to cover today are the reinvestment risk, the liquidity risk, the low real rates of returns on GICs, unfavorable taxation of GICs versus investments, and market timing. The first thing to consider is reinvestment risk. The current 5% GIC rate that you might get today probably will not be available once that GIC matures. You will then be forced to decide to either renew at a lower rate or re-enter into the investment market, which at that time could be at an elevated price when you're trying to buy back into it. If the Canadian economy enters a recession, the Canadian government could be forced to cut interest rates in a hurry, and GIC rates could come down quite quickly. The reinvestment risk in that scenario on a balanced portfolio is negligible. If interest rates decline, the fixed income component of your balanced portfolio, meaning the bonds, will benefit from the inverse relationship they have with interest rates. As interest rates come down, bond prices will come up. The next thing we want to look at is liquidity risk. The best GIC rates are available on a non-redeemable basis, meaning that if you want to access your money, you can't get to it. It's usually locked up for a period of the term, whether that's a year or a year and a half or 2 years, depending on what you chose. Now, if you are able to get it, typically you have to forego any interest you've earned on it. This makes them not ideal in the case of an emergency or whether you're planning to access that money in the near future. On the flip side, what I would recommend instead of that is potentially using a high interest savings account so that you can have that liquidity at any time. The high interest savings accounts may pay you a little bit less, but you can access your money whenever you need it. On the flip, additionally, when you want to compare that to a balanced portfolio, there is no real liquidity risk. You can always access your money at any time at the current market value. We also need to consider low real rates of return. The nominal rate of return on a GIC portfolio over the last 10 years is well below the 7.9% average of the TSX Composite Index. Real returns on an inflationary adjusted basis from GICs are generally very low and can even be negative in an inflationary environment like we're in today, which means that the actual value of your capital or your GIC is being eroded over time. Although GIC rates are high, say at 5 or 6%, we need to ask ourselves why this is. And the reason is because they had to raise interest rates because of inflation. And we look at inflation over the last year, we want to ask ourselves, what has it been and what does it really feel like? So if we want to say inflation has been on average 5% over the last couple of years, and we're making 5% on our GICs, what we have to realize is that we're not really making anything. We're just keeping up with inflation at that point. On the other hand, blue chip stocks held in a balanced portfolio have substantial pricing power and can therefore generate long-term returns that are well above the rate of inflation. As always, we need to consider taxation. If GICs are held in a non-registered account or in your bank account, they are taxed at your marginal tax rate, which is your highest tax rate. So if your marginal tax rate is, say, 30%, then you're going to be paying 30% tax on any of the income and interest you earn off a GIC. If you are in a top marginal tax bracket of over 50%, that means that you will be paying over 50% on the interest that you earn on that GIC. While interest earned on your bond investments and portfolio is also taxed at your marginal tax bracket, which is your highest rate, there is also currently the opportunity to earn a capital gain on your bonds. The capital gains are taxed much more favorably at half the rate of your income tax rate, of your marginal tax bracket. On the equity side of your balanced portfolio, you may be investing in Canadian stocks that pay Canadian eligible dividends. These dividends are taxed very favorably. For example, if you earn up to $50,000 a year in income, you will pay negative tax on these eligible Canadian dividends. If you earn upwards of $100,000 a year, you are again paying practically no tax on these Canadian eligible dividends at 1.63%. And where I come from, paying only 1.63% in tax in Canada is what I like to call tax-free. And last but not least, market timing. As we all know, market timing is extremely difficult. If you are planning to buy a GIC for a year or two and then jump back into the market and hopefully ride it all the way up at that point, that may be extremely difficult or near impossible to time. Most likely, we will miss the bottoms and miss that quick bounce on the upside. As always, the best strategy is to stay invested and or be invested for the long term. Again, we cycle back around to focusing on our short-term and our long-term goals. If we need the money within the next 1 or 2 or potentially even up to 3 years, we think using a GIC or a high interest savings tool is just fine. If this is longer-term money over 3 years, then perhaps you want to look at the opportunity of investing in a balanced portfolio, as well as staying in your balanced portfolio for the longer term. Thank you very much for watching, and if you have any follow-up questions, please do not hesitate to give us a call or reach out to your advisor.